All right. I believe we're live. Yes, we are live. We're live both on LinkedIn, Facebook, and YouTube. This is Real Fridays. Every Friday at 12:30, we have a special guest, obviously Chad Smith, that we've marketed on LinkedIn, the Chief Operating Officer over at Better. But the hosts are Brock Cassidy, myself, Rick Rock, and Jeremy Potter. Just to kind of give you the framework, Chad, with what we do is really the strength of the show has been, it's been just real talk. As you know, leading into this, it's totally unscripted. We have a lot of questions that I think are going to feed into educating the audience on who Better is, who you are as a leader, who Better is as a company, and where, from your perspective, and from our collective perspective, where this industry is heading. I'm a retail IMB expert, right? So I've been in this business for 25 years. I'm an advisor to a lot of companies that, on their growth strategies historically, on M&A, acquisitions, branch acquisitions, and various sort of retail growth strategies. I'm presently serving as the vice president of new growth over at NFM Lending out of Baltimore, Maryland. Brock is our kind of our tech expert from coming from Rocket, but he also runs chief revenue officer over at NewZip, which is a really cool realtor to consumer to lender engagement tool and technology, and they've done an incredibly good job gaining market share. And Jeremy is a lawyer. I've used him pretty extensively in a number of projects, but he's a lawyer, retail lawyer, wholesale lawyer, and he's done a lot of advisory services for tech companies that are looking to disrupt mortgage, either in title, appraisal, or just operating workflow. Right. So I think I'm looking forward to him joining sort of the podcast. So our first question for you, Chad, really is tell us about you and your journey. I mean, I consider you a blue chip guy, right? You're kind of an IBM, Dell, and now you're working for Google, right? You're kind of a blue chip stock professional in this business. Have worked for and been very successful at a variety of different brands, Loan Depot and so on, Caliber. And now you make this jump to Better. Like, give us that stumped me at first, but let me give me an idea as to how that came about and why Better.
Yeah, well, it's great to be with you guys. Appreciate the time today. So for me, I've similar to you, 25 years in the business, mostly around consumer direct, other than partnering with retailer, wholesale, by being part of a larger company that serves those businesses, whether that's lead routing or portfolio retention or whatever we can do to serve loan officers, and how can, consumer direct or data and analytics and lead routing and those types of things that are usually core competencies in direct to consumer, serve other channels. But yeah, no, I've been very blessed to work for some great organizations over the years. What I would say is, Better, obviously, went from, in 2017, 2018 at, $500 million a year to, $58 billion in 2021. And they did most of that through technology, customer experience, and kind of hiring non-mortgage people, right? And the mortgage market created quite a tailwind in 2020 and 2021. And so I think, Better had, kind of an epiphany after, focusing on cost structure over the last couple of years, like the rest of the industry. Hey, this is a tougher environment. We're really good at technology. Maybe we should, partner with some, experts in consumer direct. And so I think like the rest of the industry, right, I used to watch them in awe and anger. Right. Like, you hated getting a loan estimate from them. Those
damn rates are so competitive.
That's right. You were shocked at the growth and the success. And then the technology is real. I think like a lot of people, I went through the journey myself. Right. And so, when they called, I was like really intrigued. And so for me, it was like, I think historically you've seen fintech struggle, do really good in consumer loans or maybe auto loans or, some of these things. But whenever they get to mortgage, like it had been a struggle, whereas, Better kind of started with mortgage and then added better real estate, better cover for insurance. So they figured out the hardest piece first. right? And so when they called and I looked at the opportunity, I mean, just candidly, I thought I could really make a difference, right? Really loved the team. Went through a journey to get here. And everyone was so mission driven. It was about creating more home ownership, and it was real, right? It was real, and you could feel it. And I would just say, whether it's Vishal and even the rest of the team, is just people think differently. And so, and I think that's great. And then sometimes, getting kind of that operational mind on when, customer acquisition cost is a way different animal today than it was in 2020, 2021, right? And, conversion, optimization, and those types of things, which, I have experience doing. And in my, I guess, simple thought was, God, if you could marry this tech and vision with like, the old mortgage guy a little bit, can we just create real magic? And so that's the why and the how and how I got here today.
So is there any, it's kind of interesting with Better in its evolution, because it's obviously, well, let me say this, right. And as I was telling you, in the lead up to the call, Brock, myself, and Jeremy, we're fans of Better. Really, it's almost like walking by a church and you're just observing from the outside in, sort of the pretty stained glass windows. But we don't really know how the church operates because none of us have been in it. We don't know really anybody in it. But we admire kind of the disruption that you guys are doing. How different do you guys look at your identity as a Rocket Part 2? Do you feel like you're doing things differently than Rocket or better than Rocket? Like, how do you, and which is a pretty grandiose thing to say at whatever, 3.8 billion or so this year. But at the same time, I think you guys mirror Rocket in a lot of in the way that you do business, or does it not?
Yeah. So I don't think we, sit around and compare ourselves. I mean, they're an amazing company. We've all been chasing them in the consumer direct space for years. I have a ton of respect for what they do. And they're a formidable competitor to the whole industry. And then they also contribute tremendously to our industry. I think for us, everything that we do, really starts with how to make it, easier, faster, better, right, for the consumer. And so I think a lot of what I've been asked or I've identified as areas where I can make a contribution is, if you think about our technology stack, Tin Man, and the amount of optimization that we've put in, going public and getting additional capital. So we're, I think in the top 10 of well-capitalized companies out of the 4,000 mortgage banks out there, which we, puts us in a position to invest and lean in. And so if you look at the last 24 months, and not that we ever stop variabilizing our cost or looking at cost efficiencies, but I think a lot of the focus was that. And so now we're trying to lean into growth a little bit. But when you really think about the technology, it's really been driven around the consumer. And I think we have this analogy is, on a $1.5 trillion, market, let's say, maybe 150, 200 billion of that, the customer is willing to do everything online, like, kind of equated to those, driverless cars. Like, there's people, there's not that many people that are actually willing to get in a driverless car. And so you say, hey, we do really good on this 150 billion, 200 billion. We have customers that come in, our one-day mortgage, they get verified, they close, they trust us to handle a purchase transaction fully online, with a consumer direct loan officer helping. But how do we get to where the customers are on the rest of the 1.3 trillion, right? And so really expanding Tin Man, more so for the loan officer too. And so that's, how we think about things. And then obviously AI is pretty core to what we do. And I'm sure we'll talk about that in a little bit here. But so that's how I think about it, right? Is how do we create more homeowners, right? We're very mission driven around homeownership, creating more homeownership. And we're kind of agnostic to how we do that, right? Like if we want to partner a lender in a white label solution, we're willing to do that, because we are just focused on creating homeownership. It really starts, with Vishal's frustration of trying to buy a house and immigrating here, and what a home meant, right, to that family. And so that's kind of where we are.
Yeah, that's interesting to hear. We got Jeremy on board now. I think you can hear us. But Jeremy and I were both at Rocket. That's when we met, on kind of like the day of that Super Bowl ad, push button, get mortgage. And that, you know, at that time, and for the most part, still 100% of people would take an off ramp. They would not just push the button. They would talk to someone. And then for a while, it was 99% of people would take an off ramp. I don't know what the number is today. We've both been out of Rocket for a long time, and you guys, I'm sure, have a number of how many people go 100% digital. But it, you know, that trusted advisor role still seems to be coming in play, you know, almost every time. So that's interesting to hear that you guys are thinking about that, but taking your consumer facing tech stack and bringing it to other parts of the industry, I guess, is kind of what I heard, right? Bringing like through partnerships.
Yeah, whether that's local loan officers, whether that's partnering with other brands that need technology outsourcing. You know, we obviously power Ally, you know, and so you know, we've had partnership in our DNA well before I was here.
Chad, let me apologize for being late. Rick thinks I do it on purpose, but it's important for me to note I did not. I am here at 12:30. It's just I had the cell phone didn't accept the new browser update and some nonsense. And so I know I'm supposed to be tech savvy. So it's very hard for me to admit that I was 5 minutes late because of technology, but I really appreciate it. The understanding, the flexibility. Real Fridays has always been, I hope, a little more casual. And so as a result, you know, let's lean into that. But thank you for joining us. I know.
Yeah, no, good to be here. And from my extensive travels, that looks eerily familiar to an airport lounge. So I totally appreciate the commitment there. You could have just blamed TSA and we would have been fine.
I know I probably could have, but I'll take responsibility on this one. So one of the things you mentioned struck a chord with me, the experience and what the consumer wants. And I've been going back and forth with clients for a while now, maybe 18 months, on like, what is the expectation of mortgage versus what it should be? And that we've gotten to a point now where customers, especially on the purchase side that you mentioned, have such a low expectation, honestly, that doing just a little bit better is enough. But I don't know if that's actually what they want. So when you think about moving people from that smaller tranche, the 200 billion tranche, and now starting to pull in that 1.3 trillion tranche, is it resetting expectations? And if so, how do we do that? Or is it honestly that we don't believe they want the better experience and like good enough is good enough because the transaction is just always going to be a mess because that's what a purchase is, a human endeavor.
Yeah, it's a great question. So I think when you look at most, you know, if you went and talked to everyone you know that got a mortgage, regardless of how great the experience was, I don't think anyone's like, oh my God, that was amazing, right? So, you know, I mean, you know, there's like 97% of Americans own a smartphone, 85% are like Prime members, and it still takes 50 days to close a loan, right? And so, I think that, you know, so I do think speed, certainty, cost, right? Like, and I don't mean cost like in margin, I just mean like friction cost, right? Like time kills all deals. You know, all of that, I think the customer just wants a better experience. And technology can really help that. I mean, we're just starting to see the early innings of what AI is really going to do to this industry. And I applaud like the FHFA and others for having like tech sprint. Like people are trying to responsibly get this going. And a lot of the big industry players are going to, you know, help the rest of the industry, right? Kind of get there, right? And so to me, it's all about how to make people more productive. We have this highly regulated business that the cost to originate a loan is still way too high. And so, you know, to me, it's like, you know, I always like use this example about loan officer compensation, right? Like so many people focus on that. And I really don't focus on it because it's kind of like the market sets it, right? It's like, you know, do you want to hire someone or not? And so really, if there's a loan officer compensation, you know, threshold, then is it that person doing 4 loans with you, 6 loans with XYZ, and 10 with me, you know, because the level of effort is the same. And so I think as the industry, as technology continues to come into the industry and make things easier, better, faster, cheaper for the consumer, you know, that helps. I think in like my experience with NPS and customer surveys, you know, really over the, you know, the last 20, 25 years, is there is a direct correlation to what interest rates do, right? And so, when your cycle time 60 days, but rates 3.25, you get good reviews, right? Not all of them, right? But there is a correlation. So how does the consumer feel? And so I think as we've all learned in the last, since since the markets, reset, getting our fixed costs down is really important. And this is a time where margin, maybe a couple of years ago, the realtor says, use my person. They come to the transaction with the barbecue set and no one asks questions, right? But now you're seeing with affordability and just, online becoming more available, people shop and Optimal Blue, all these pricing engines that have created so much transparency, consumers have gotten more, and I don't even know it's about being savvy. It's just out of a necessity, right? Rates were so low for so long. And although, from a historical perspective, I guess they're still low from historical, but not from where we were, right? I think it was, I think 85% of the market of the homeowners are 100 basis points plus out of the market, right? Like, in other words, their mortgages, like, until that they're even like willing to talk to you about a cash out refi or thinking about moving, you need 100 bips in rate, right? Which is, created these inventory challenges, the lock-in effect. And I think pre-pandemic there was 2 million homes available. Now we're like maybe 1.3, 1.5, so it's like maybe 500,000-700,000. So it seems like it's unlocking, right? But the other thing that people forget sometimes, like the data is pretty clear. It's like on the average person, it's 55% of their income to become homeowner, whereas a renting is closer to 40. Right. And so you have this affordability thing. And so what, obviously the government can be helpful there, but also what we can do as an industry to make things, transactionally lower. Right.
Yeah. Yeah, that's right. And we're not really good about on-ramps either, because what we're really seeing is if you can afford a home, you can really afford it right now. You may not be able to find one, but you're financially speaking very able to afford it. And if you can't, or you're a renter, you really can't. So there's kind of like a gap between who can and who can't. And if you can't, you're really struggling. And if you can, you pretty much can. You just can't win a contract in a lot of markets. So we're seeing that kind of separation. And we're not, I don't think as a mortgage industry, necessarily there yet on how to figure out either that kind of middle ground or moving people over time and making it cost effective to get you from one group into the other as well. So I think your points are really, really well made.
Let me ask you a question just about market share and kind of where Better is at today, at least from there's Redder, there's Ingenious, there's different platforms, and my favorite, to be honest, is Ingenious, because I think it gives a really in-depth view of different companies. But it seems to me Better is right around, we'll probably do just shy of $4 billion this year. Does that sound about right?
Yeah, I think we guided to $1 billion for Q4, so I'll leave it at what's been stated out in the public markets. But
So does a purchase market hurt Better, or in other words, because you don't really have much of a retail presence, do you? Or is there any kind of retail strategy to Better, or is that something that you guys would ever explore? Like, what's the thought process? Because it seems like squarely, like you had said, that you guys did enormous amounts of volume in 2020 and 2021 when refinances were plentiful, and of course purchase production as well. But what's the strategy around staying on top of the, from a market share standpoint, despite the pendulum really swinging more and more to a purchase driven market?
Yeah, so I would say subscale, in consumer direct purchase has been notoriously hard. We actually do it really well. And I think a lot of that has to do with our technology, what our leads kind of become when they get to a loan officer. And, we have a great brand, digital brand. We obviously did a tremendous amount of volume over the last 8 years. And so we have a huge return customer base. And so, but, I also would say that a lot of consumers come to our website, get pre-approved, and then maybe leverage that, right? Or the real estate agent says, use the local person. So we have a lot of conviction around local strategy. When you look at, I think if you just looked at some of those services you just said, or even public record data, and you said, what is a typical consumer direct, such as Better, if you look at the amount of pre-approvals that they generate, maybe 40% of those never go anywhere, or maybe the consumer ends up staying in their home or getting a HELOC or a refinance, and then maybe 10 to 20% close with that consumer. And so that's 50, 60%. The other 40% closes locally, right, with competitors, and frequently at a higher price. So that's just what the data tells the industry. So I think it would be pretty naive to not say that you're not a believer of the local professional.
Why not do a retail strategy? Because it seems to me that with your tech and your streamlines of costs, you could really deliver a pretty thin margin, competitive, price to the street from a retail standpoint. I mean, Cross Country does a couple billion a year in consumer direct. New American Funding is pretty competitive on their consumer direct. Loan Depot is very strong in their consumer direct sort of strategies, as you well know. Why not do them both? I mean, those guys have been pretty successful at sort of balancing the two.
So I think we have a lot of conviction around that strategy, and you'll see us doing that. I think the mortgage business is obviously into 4 channels, right? Correspondent, broker, retail, DTC. And I think for us, like when I think about how many consumers we can generate and how many consumers trust us as a partner, we think there's real scale opportunity with our verified pre-approvals when we, with that data where we, kind of lose, customers to local. How can we feed local? Right. And so, and win that real estate agent over and have that real estate agent trust. I think notoriously I hear, not necessarily specific to Better, but I would say any of the large consumer direct lenders would say something like this, right? How many real estate agents say, don't use that online lender, go use my referral partner. And so I don't think, just kind of back to my earlier comments around like attracting the rest of that total addressable market, which should be expanding in 2025. I think the MBA is forecasting another 600 billion, which is largely going to be purchased, right? And so for us, we're very focused on attacking that via local channels, and not just with our 10-man technology, where we think people will be more productive and get more productivity and have a cheaper fulfillment cost, because we average like 35% less than the industry average on fulfilling a loan, but also through our marketing, right, or lead ingestion, that especially when a consumer comes through and gets a verified pre-approval, where Tin Man is fully validating that within the 1-day mortgage, it's a very high intent lead. And and what does that do to generate more referral partners, and what kind of flywheel can that attract? So we have a lot of conviction around that.
Chad, your comments really fire me up, because I've been obsessed with that exact problem statement for a long time. And one of the things that my brain tends to go the product manager question, the product side question, but it's true of the whole equation, which is, how much better does it have to be? Because I think what you just described is that in reality, we can actually deliver through digital technology enabled lenders like yours. We could actually deliver a faster, more certain, not only approval, verified approval, like you said, but cash to the table. And I've been setting out this goal for mortgage companies to be better than cash, because I actually think the reality is that it is better than cash. I think cash is slow. I think cash is fragmented across a bunch of different accounts. I think cash buyers aren't actually faster than the verified approval buyer that you're talking about. And
they pay below market is the norm. Yeah,
that's right. But the perception is exactly what you laid out, Jed. So how much better does it have to be able to flip that script when we know what's possible and we're still fighting a perception? But shouldn't a nationwide lender who does this all day, every day, funds tables in every jurisdiction, everywhere, be better than a cash buyer in a competitive bidding setting? And why are we still fighting these myths?
Yeah, so that's a great comment, and I think it all starts with product. To your point, and when I say product, I mean technology product, right? And so when you look at our one-day mortgage and our verified pre-approval, I mean it's not a pre-qual, right? We honor that, right? And the customer can come in, change their down payment, change this, change that. It just generates everything online for them, and we have the machines, validating all of that, right? And so and I don't want to quote the wrong stat here, but there's a large percentage where our customers are getting fully verified in minutes, not one day, right? Not 8 hours.
Yep.
And so so obviously that's kind of the happy path, where all those validations are the person works where you can validate income and those kinds of things. And so for us, I agree with you, right? And there's a big culture, at least at Better, and I'm sure a lot of places, where it's like certainty, speed, execution, right? And so working here now 6-7 months, we just don't have a tremendous amount of customer issues. And I would say, in my experience, right, being online or consumer direct, purchase has never been great skill sets at large scale, right? And so issues with closing or miss that, right? Because it's not the same hand holding, right? It's just different product set, where I think most people think of DTC as like this conveyor belt where you just churn refis and it's fast, easy, right? And so we've actually taken real stabs at that and continued after the IPO with fresh capital, really continuing to lean into our product, right? And so our technology product, Tin Man. And so and I think the other thing is like we're on one proprietary system, right? So we have all the data, right? And that's why I think a lot of our AI capabilities are have an advantage, because I can teach Betsy off 10 million recorded calls from all time, like what went wrong, what went right, and and so to me that is where AI and technology will really make things better, because I do think you got to go back to that local or consumer direct, but just the real or the loan officer, right? Like, it is an emotional transaction. They are not going anywhere, right? The flip side is we have this cost to originate problem. So how do you enable them to do more, right? That's what I think is what the industry is trying to solve for. And I think on the consumer direct side, it's a double-edged sword because of customer acquisition cost in a really tough macro, just because the funnel, of people applying for a mortgage, and then, a lot of people applying, could be in a different situation. So, your denial rates are up, and you really have to watch, like in a consumer direct shop, the largest expense line is always the marketing. And look, when we've built, we've been bringing in, team. We hired Jessica Manna. We've brought in some mortgage experience to complement our technology and in fintech, skill set.
So I just want to make sure I don't put words in your mouth, but so that thesis sounds to me like it's just a matter of time. That like essentially mortgage lost the trust of real estate at some point over time, and the local person had won the real estate agent's trust somehow, and so it's just a matter of time. Is that a correct characterization of sort of where we're at?
Well, I think it's I think it's a matter of time. Like, look, I think it's a matter of time for local loan officers to do more through technology.
Yeah.
Right.
Okay.
Like, I think it's like whether they're, taking on more leads, because when they're out driving around and meeting with real estate agents, that, there's an AI voice person making appointments and doing things right that make them more efficient. Right. And so that's where I think the opportunity is. Because all this disruption, to me, the focus is going to be on, like, obviously the servicing side of things, the cost side of things, the compliance side of things, right? But for what I think we're focused on, of course, with those things is, how can we get more throughput through the use of technology to drive manufacturing costs down, to make that local trained professional that is truly a trusted advisor, right? It's like, very rarely, people that like say, oh, a real estate agent charges so much. I mean, there is no amount that's not worth it when you have a great agent, right? And it's the same thing with a loan officer, right? And so local loan officers are setting that customer up. They're true professionals in what they do, right? As shown by their their earnings and everything else. And so how do we just make it easier for them as well, so they can do more?
Tell us about Betsy. We had on our podcast a Stanford grad student who launched a company that does a lot of voice AI for sales automation strategies, right? To be able to automatically sort of pre-qualify or kind of go through a series of sales steps with the consumer, and then to determine like the readiness of the consumer, and to the point of even transferring or doing a live transfer to a live loan officer that's waiting. So that way you can have this AI assistant that's rifling through hundreds of thousands of records and not relying upon whether or not the loan officer is actually picking up the phone, him or herself, to doing it. And it was interesting because it's talking to this kid, and he literally was just a kid. He was probably 25, 26 years old, but extremely smart, very accomplished. And his value prop was exactly right? We want to help sales professionals in their outreach to data mine their past prospects more efficiently with better results. And then I was listening to the Housing Wire podcast you had with Diego, which I thought was really good. And you had talked about Betsy. Tell us a little bit. It sounds essentially that you guys have built in-house what this kid is bringing to market as a Stanford grad student.
I was gonna, and I'll just sort of on a generalized version of the same question. I'd also love for you to expand on, Chad, like the way VCs usually ask the question is like, what does Better need to own versus partner for? And is voice AI sounds like it is one that you guys want to own. So is that true of a lot of obviously you guys have developed a lot of your own tech stack versus partnering. Is that something you see continuing? Is that part of the strategy to potentially resell the tech stack and things like that as well as you keep building out things like Betsy, Tin Man, et cetera?
Yeah. So, there's a lot there. So, okay. So we're not allergic to working with anyone if it helps us get, further faster, right? It's all about, fulfilling our mission and driving cost to transact down and customer experience up. And we're not agnostic to how we do that, what channel, et cetera. So I would say with Betsy, it leverages, obviously large language models to accelerate really the customer, right? So you can call and 24/7, answer the phone. I would say the next iteration is, reading facts in Tin Man, which again goes back to like one system, and being able to answer questions and get a hold of customers that want to transact on the phone and actually transfer it to a consumer. And we have a website up with some calls, right? You can just go there to better.com/Betsy. But what I would say generally is we are obsessed on that. We spend a lot of time on that, and we've been working on it for months. And I would just say as a mortgage guy, not necessarily a technologist, right, but a user of technology, at the pace at which things improve, I have a lot of optimism for our industry to solve a lot of these problems, right? And there's probably 100 of those 25-year-old Stanford kids, figuring these things out. And probably a lot of it becomes commodified at some point. We are very proud of Betsy. We've been working hard on it. I would say that is like something that I just feel blessed to like work in a culture like that, where you just lean in, test, test, push the envelope. But she's making thousands and thousands of outbound calls, and then I think for it's like, how do you guardrail that? How do you make sure she doesn't hallucinate, and all of those things is important. But before you go live, you have to know that. And so I don't know anything about the other guests that you had or what their system looks like. But we have thousands of examples where there's real value being created. And I think that it's going to change the game. And I think if you take that locally and or to any other channel, candidly, and you have 24/7 someone answering the phone that can look into a file, read the facts of that file and answer questions, and then let someone know that's going to just create better service. So when you go back to like, the earlier question around, do we just set the bar too low or too high? I think all of those things improve customer experience, and customer experience includes closings and, should take friction costs out of the system.
Yeah, I think we'll head more and more towards the functionality being commoditized, certainly, but the training of it that you guys have access to is super unique and something that could be beneficial to tons of people in the mortgage industry who don't have that asset, by having the lead flow you guys have and the top of funnel engagement you guys have to have all these, first phone call type conversations at ridiculous scale. So that makes a lot of sense as a differentiator.
Yeah. And I mean, look, we get asked a lot about, our technology and outsourcing it. And like, we have all conversations, right? I think but at some point, or, what's important, especially coming out of this cycle, is that you remain disciplined on what's your true North Star. And so for us, partnership, you get to use it, but we're doing the fulfillment, right? We're doing we're doing some type of large scale partnership, where you're basically, leasing Tin Man, so to speak, and better to fulfill mortgages. Whether we go license our other technology, that, we'll always talk about that, but I don't think it's like on the immediate roadmap.
What do you think is a disruptive target when it comes to operating costs, like whittling down the cost to close a loan? What do you think? Because it's kind of a race. It can't be zero, right?
Right.
I mean, that'd be truly disruptive. But where do you think it gets down to where all of a sudden, or you could make money in other channels and all of a sudden and give away a mortgage. I mean, to some degree. I guess it just kind of depends on where the money is.
It's a good innovation question. Yeah, if nothing else, it's a good prompt for an innovation question. But that's why I was smiling. But yeah.
So
I didn't mean to interrupt.
I thought that was great. I agree. At zero, it would be truly disruptive.
Yeah.
Look, I think that the thing that people in the mortgage business sometimes, because we're so cyclical, right? So like, if you're growing right now and you're adding all this headcount and you have like guarantees and all these things, right? That's all going into your fulfillment cost, right? And so, and then if you're, cutting, I guess it's a different cycle, right? That's coming out of your fulfillment cost. So then it's like, what's your true fixed cost at what loan? What's the next marginal loan, right? So, I do think for a, maybe wholesale aside for a second, if you think about post-lock fulfillment to close, I think $500 is really disruptive. And I think that is going to be doable with how fast technology is moving, pretty easily. And I can tell you those are the types of things that we push for and set for targets. And I think it's always like a little soupy right now, because I think like in 2023, especially if you take fixed cost and compliance costs, it was like 22 grand to originate a mortgage at a bank. It was like 16 at a regional and 12 at an IMB. Right now, that's obviously because the loans are much lower and you still have some fixed costs and people are exiting now. But like, so then it's like, oh, well, I'm below that or whatever. So for me, it's finding those true North Stars and then obsessing on it. And then I will say it needs to be cultural, right? And so, and depending on your size and scale, like, does that include board support and CEO support? And are you hiring the right people to do those things? Are you partnering with the right people? I think we've seen in this industry time and time again, new technology come out, and then the next thing you have 6 different contracts and your costs are going up. Right. Yeah. And so like, are you being disciplined? Are you like making the tough decisions to say no? Right. And so.
Absolutely.
So the $500 a closed loan, I agree with you. It would be remarkably disruptive, at that level. What I like about your strategy from a partnership standpoint is you're doing what a good tech company does, right? You want to gain greater wallet share of the consumer, while delivering good service and good value and lowering the costs of all those services because of the way you're integrating, sort of vertically integrating all the household related services that a consumer sort of pays for. It could be homeowners insurance, it could be home warranty, it could be title, it could be insurance, it could be different types of that the consumer is going to pay anyways. So why not get it through a one-stop shop kind of approach? I think that makes a lot of sense. And I think if you drive revenue in through those ancillary, revenue channels to some degree, I think to some degree, we've talked about this with appraisal, Jeremy and I, where we've almost said that, like, essentially the appraisal could and should be free, depending upon the other sort of ancillary services that get monetized from extracting all the data you're getting from the appraisal. If you do kind of a 3D and an image kind of in-house kind of appraisal, and you're able to sort of do partnerships with appliance companies and different organizations to basically say, hey, we'll give you a free appraisal if you let us effectively, scan your home and what's in it, right? So I think your strategy is incredibly forward thinking, and I think those ancillary pieces can really help either subsidize or underwrite those costs, or just lower those costs pretty dramatically.
Yeah, that was one of the things that attracted me to Better is, they had already had all the hard, like, putting in, better real estate, better cover on the insurance, like, and admittingly, like when you're in a cost out environment, like the whole industry's been, right, like those things become less important and less focused, but all the infrastructure bones and they are still operating, right, is there. So when things change and you get through this, it's easier to, fire everything back up. And then I think there's going to be other technology that comes out, or partner solutions around, payments on servicing. How do you retain that client without actually owning the MSR? And so, I think, Rick, where you were going is like, through that flywheel, right? Because we all know that if a customer only refinances every 7 years and they only buy a house every 10 years, or 7 for a purchase, 4 for a refi, you have to find other ways. And it's, with how much servicing has been aggregated up at the big originators, right? Like, you better find a way to be more sticky with that customer, because the servicers are in a really good position right now, right? And so I don't think anyone predicted that so much MSR, being sold was going to end up with a bunch of, kind of a core group of folks that have big origination arms. And so, that refi market, when if rates drop 100 bips today, like, everyone goes online and searches. But if they're grinding down an eighth, right, like that's going to be harder to capture unless you have more touch points with the consumer and provide an amazing experience, so you're top of mind. I think local does that really well as well.
Yeah, I think that brings up a really good question. It's somewhat theoretical, but this has been such a great conversation, and you're going to have a perspective on it, which is, when you think of it as that flywheel, when you think about everything you need, we've anchored a lot historically around mortgage being really hard and really complicated. But we also, I think everyone in the industry quickly admits that it's the home and the other things you're trying to do in your life that are the magnet. Everyone says that. You'll hear everybody say, well, they don't want a mortgage, they want a home. They don't want a mortgage, they want the money to do their life goals. And so we say that right away. But we've long then also, somewhat in conflict, said, but it's so hard, we're fine. It's so hard, we'll always be this key piece. But what you're saying, what I'm hearing is, there's actually this sense that if it's proactive and if it's ongoing, theoretically, it's the strongest relationship the consumer has, whether that's a brand or an individual, that is going to dominate that access point, is kind of what you're saying, right? So, like, I guess. Yeah,
I mean, look, I think that, in the last, I don't know what, 7 years, if you think about local originators, just their picture on the servicing statement, right? And how IMBs are choosing subservicers, or if they have it in-house, to keep them on the statement. So every month they see, they see Chad Smith on that picture. So, and I would imagine, and I think that's been, huge recruiting, and, like, I think that's really helped the local originator, right? And so that's just one thing, right? So then if you're like providing homeowners insurance and you help them get their real estate agent, or I mean, title insurance, probably not as much, but, if you're helping them put solar panels on their house, like whatever, like home warranty, all of those things, and that flywheel. And the local LO is more of a trusted advisor, right? Or in the case of Consumer Direct, the company, the brand is more of a, all encompassing solution. You should have, more lifetime value, right? From that customer, and provide real value to them. And when I'm always amazed at, the people in especially in distributed retailers, so good at their job, right? But it's like the referral network. It's like, I got a person for this, and they're solving that via their relationships, right? And so if you can actually create something that make that, but maybe that's just the best ones, right? And so how do you help everybody do that, right? And make that loan officer more effective to close more transactions, and then that's a reciprocal referral, those kinds of things. So I know that we're at time, so I should stop talking because I can get going.
Listen, Chad, thank you so much. I mean, I think you felt the same thing we did, which we could go all day about some of this stuff. So really appreciate it.
Well, we're looking forward to seeing where Better goes. And I think one of the questions we wanted to understand was how much better can Better get, right? And can better best better, right? In the future evolution, I still think retail would be a good strategy for you guys. Only because I think in a very purchase driven environment, it's going to be tough. I think to really accelerate, market share in a la 2020 and 2021 without the market really driving and pushing that, in your direction. But I think you guys could disrupt retail in a lot of ways, kind of as you've perfected, because consumer direct is painful, and you guys have really figured out a way to make money on it and add a lot of good value and services around it. And I think retail, you guys could be a real force to be reckoned with, for sure.
Yeah, no, we agree, and we're very focused on that, right? So we think that meeting customers where they need to be met, right, and creating solutions with our Tin Man technology and Betsy for local originators is a winning formula.
Yeah. Well, we appreciate having you on, Chad. This was great, and we appreciate getting to know Better even further. So this has been great. Thank you so much.
Hey, I appreciate the time. I'm totally honored to be with you all, and look forward to our next one.
All right.
See you soon.
All right.
Take care, guys.
All right. Take care. Bye-bye.